This video is going to be a little bit different. If you're just starting out in the investing world, or if you've been going for just a little bit, I think back to my early investing days, and one of the questions that I had for myself was, why should I invest money? What's the value to me for investing money? So today, I want to talk about that and how to think through that for you younger investors, you who are newer to the investing arena. So if that's something you're interested in, stay tuned. Hey guys, Kevin Burgess back again with another video. This one is going to be a little bit different. I want to talk to those who are just starting out in the investing arena. Some of you may be younger, some of you may be older, but at the end of the day, you're probably sitting there asking yourself, why should I? Why should I invest in the market? So I want to talk a little bit about that today to help frame that discussion for you. I look back on my investing career, and if I had not started investing when I did, I wouldn't be at the place that I am now. And so what I want to do today is I want to share with you from my perspective. I'm on the other side of this, and now you're on the front end of it. I want to talk to you as someone who has been through the journey. And hopefully this will resonate with you. I want to help you understand that there is a reason to invest. And being an investor actually brings some stability to your life and putting you in a position where you can live a life that I call personal freedom, where you're able to do what you want to do, helping others and giving back at this point in your life. So if we don't have the investments it takes to live off of that passive income, then we have to continue working, and to continue working, we're then focused on ourselves and building up our portfolio so that we can accomplish that. Once we achieve personal freedom, though, we're able to then lift our eyes above the horizon, and not look so much at ourselves, but look at the needs of others and be able to help those who need help, and in one way or the other, whether it's financially or mentorship or training or coaching. So there's a lot that we can do as dividend growth investors once we achieve personal freedom, and that's where I want you to be. So with that, I want to try to make a case for why you should start investing if you're not, and why you should continue if you are. So with that, let's get started. Okay guys, you know that one of the things I love are charts, graphs, and spreadsheets. And so what I did is I put a spreadsheet together that tries to answer the question, why should I be an investor? And what I did is I put some assumptions in place. The assumption is that you start saving $50 per week, and you increase that savings by 10% each year. So in year one, you would save $50 per week, which is about $2,600 per year. And then in year two, you would save $55 a week, which would be about $2,860 a year. So, but each year you would increase that savings by 10%. And that's not an unreasonable assumption, because you will, receive increases, and, you'll get promotions over your career. So, 10% increase is not unreasonable. Then the amount of time that I'm assuming here is 30 years. So if you're 25 today, this would be at your 55th birthday. If you're 30 today, it would be 60. If you're 35, it would be 65. So over 30 years, then this $50 per week growing at 10% with no interest at all. So your investment, let's say, is $427,684. So that by itself is not a bad reason to start investing. But then I thought what I would do is put together some scenarios. We have, a 2% assumed interest. So if you took this $427,684 that you would save over a 30-year period and have that grow at 2%, it comes out to, as you see here, $90,717 in gains. So the way to read this is $427,684 would produce an additional $90,717. So in total, it's like, what is that? 517,000 or so in total. And that's where this blue line is on the chart. So if you just take the money, save it, and get your passbook savings rate, I'm assuming a 2% rate. I mean, it could be less, it could be more. But at the end of the day, you will have made $90,000. You would have saved $428,000. So you're going to end up with about $518,000. If you just invested in the S&P 500, I looked at the 30-year history. The 30-year history from 2021 backwards, it averages 9.9% per year in the S&P 500 and 8.9% over the last 20 years. Now, I want to take just a minute and share with you some hurdles to this. This chart here is a history of the last 30 years of the S&P 500 historical annual returns. And what I want to be very clear about here is that if you put money in a savings account, it will never lose money. You will get 2% per year every year. But when you invest in, let's say, the S&P 500 as an index, then you're going to have years where you make money. You're going to have years where you lose money. You're going to have years where you make a lot of money. I mean, look at this. This is 1995. There was a 34% increase. And then we went through the dot-com bubble, and so then all of a sudden the bubble crashed, and the market went down 10%. The next year it went down 13%. The next year 23%. But then the next year it popped back up by 26%. So the point of this is you're going to be on a bit of a roller coaster here, and if what you see here on an annual basis, you will also see on a daily basis. It's just not quite as big, right? So let's look at it on a daily basis. I mean, let's go to the S&P 500. We'll just take a 5-day look here. You're going to see, we started out the week somewhere around 4,065. And by Thursday, we were down to 3,863, 3,864. And then it pops back up on Friday to 4023, which is where it closed. So you're going to see this up and down movement. And what's important to take away from this is that you're going to have this feeling that you're losing money and making money. And at the end of the day, you're going to be on this roller coaster. So go ahead today and realize that you're going to be on this roller coaster where you make money and you lose money and you make money. But at the end of the day, that trajectory is moving higher. And so just get used to that and know that you're going to want to buy more when it's down, and you're going to want to buy less when it's up. One of the things that you learn as an investor is something called dollar cost averaging. And sometimes putting $50 a week, regardless of what the market is doing, is the best approach. Because when you put $50 in, if the market's at 5,000, it's going to buy a certain amount. And then if you put $50 a week in and the market is at 4,000, it's going to buy more. And so at the end of the day, you're going to be buying more at the lower price, less at the higher price. So your average price is going to be lower in the long run. So you want to research a bit what dollar cost averaging is. It's a great tool to use, especially for someone who's putting money in consistently, either on a weekly or biweekly or monthly basis. So dollar cost averaging will be your friend. The chart shows that if we invest and we get on average 7%, remember it goes up and down though, you're going to be on this roller coaster, but if you get 7% over a 30-year period, not only do you have the $427,684 that you put in, but you have an additional $484,547. And you say, well, 7%, I mean, that looks to be pretty high. How can you use that? Well, when I compare it to the 20-year rate, which is 8.9%, almost 9%, and the 30-year, which is almost 10%, I think 7% is pretty conservative. So, it's going to be up, it's going to be down, but at the end of the day, I think 7% is a conservative number. I mean, if you look at the last 20 years and let's use the 9%, you're not only going to have the $427,684, but you're going to have an additional $757,416. So you're going to be sitting at about $1.2 million at the end of a 30-year period, simply putting in $50 per week that's going to raise by 10% each year. So over 30 years, starting with $50 per week, growing it by 10%, putting it in the market where you can get possibly 9% return, you would end up with $1.2 million. So why should you be an investor? Your future depends on it. Remember, I'm the guy who's sitting on the other side, and I will tell you that my life is better today because I am an investor than it would have been otherwise. So I encourage you to, if you haven't already, start dollar cost averaging into at least an S&P 500 index fund. We'll talk about in future videos what to invest in. I'll tell you why I am a dividend growth investor and why I invest only in dividend stocks. And just because I'm a dividend growth investor does not mean that I don't appreciate the other investments that are out there, the non-dividend stocks and ETFs and mutual funds. And so we'll talk through what all of that means in some of the future videos. But I wanted to do a series of videos that helps the new investor, the young investor, with just basics around what should I invest in, and how do I get started. So we're going to do a series of videos on that. Let me know in the comments below if this is helpful to you. I really appreciate your feedback. I'd love to hear from you, and I love to encourage you on the journey. So with that, I'll see you on the next video.